quickly start with the key financial highlights. To your mind, strong asset quality movement. You've seen a slight uptick, but largely it's looking strong. Net interest margin improvement. How are you achieving this, sir?
Yeah, see, Q2 is always a tricky quarter, mainly because of unpredictability about the monsoon and the impact of that. But we have done well, I should say. The credit quality has held well, and as the business volume keeps going up, I think it will improve further. And adding to that, the credit demand also has been quite good in the fag end of September because of the GST reform. There has been some increased demand, and October we are witnessing much bigger demand. So I think overall it is augurs well for the Q3 is what I can say.
Net interest margin has improved 8 basis points sequentially from 8.11 to 8.19%. What is your outlook going ahead, considering also the fact that you've seen your cost of borrowing come down this quarter?
Yeah, see, we do see the cost of borrowing coming down every quarter. This time around, the incremental credit as a borrowing cost was around 8.3, and it should come down further, is what it looks like. And in the book, it is around 8.83. It's improved by around 5-6 basis point, but it is likely to improve further going forward as we reprice the borrowing going forward, because 87% of my book is fixed one and only 13% is floating. So the impact of a repo rate or the bank borrowing, bank reduction in interest rate is much slower on our book. But when we reprice it, it will look much better. So I think next 2 quarters, we do have a good opportunity to reduce borrowing cost.
Where will your NIM be by the end of the financial year, sir?
End of financial year, we exit 8.5 is what we are guiding.
Exit 8.5% for FY26. Okay, a quick question around the loan book growth as well. Your AUM is up, 16% odd. I'm trying to understand what the outlook for that is, considering the parameters you said earlier, which is that the GST rate cut has boosted demand.
I believe we should be above the guidance. We gave a guidance of 15% growth. We should be anywhere between 17, 18, especially in the third and fourth quarter. So overall, for the full year, we should be around between 16 to anywhere between 16 to 18.
Okay. A quick question around the liquidity scenario as well. In the broader system, the expectation is that there will be a liquidity boost as the CRR cut flows into the system. How much of that will come to you as an NBFC that is dependent on bank borrowing as well?
No, I think banks are quite comfortable lending to NBFCs because retail lending wise, NBFCs have performed much better. And that will help the banks to either lend directly on the book or do the co-lending. So overall, the NBFC industry should grow well, and bank support will definitely be much better going forward.
Okay, last 2 questions, sir. I just wanted to get your sense about the broader asset quality conditions in the ecosystem. There's an expectation that it's only going to improve. However, with the higher loan growth, you may see some uptick on the credit cost front. Are you seeing something similar, or is your experience different?
As of now, the experience is quite good. We don't really see any challenges, but we are cautious on MSME segment, especially the segment which are more exposed to US export. That we are a little cautious, even though our exposure is less. But credit growth-wise, lending-wise, we'll be careful on those sectors till we find some kind of a meaningful understanding between the India and the US.
Okay. Last point, sir, on fundraising, there's a lot of rumor mongering in the market, but is there anything on the cards that you're looking at in terms of fundraising? Not necessarily names, but your company itself.
See, the borrowing is the regular program it's a raw material for a NBFC or bank, and that will continue to be there. But otherwise, our CRAR is more than 20%. So we don't have any serious plan to raise equity as of now.